Welcome to the deep dive. Today, we're really jumping into something that hits close to home for everyone, your individual income taxes. Our mission really is to unpack the absolute essentials, the filing requirements and filing status for individuals. We're digging into the sources to give you real clarity on this stuff, which, let's face it, can be super confusing.
Absolutely. And this matters because understanding these basics isn't just about paperwork. It's fundamental. It's how you accurately figure out what you owe, make sure you're playing by the rules, and honestly, just get some financial peace of mind. If you don't get these foundations right, well, it's easy to miss out on savings or, worse, make some pretty costly mistakes.
Okay, right. So let's unpack this. I kind of think of it like your financial GPS, the individual income tax formula. This isn't just some random list. It's the core structure, the actual step-by-step map to figure out your taxable income, and then the big one, your federal tax liability, or maybe even a refund. And all this, it funnels onto Form 1040 eventually.
Exactly. Think of it like your money taking a journey. Starts broad. Gross income. That's basically everything taxable you receive. Then we start narrowing it down. You subtract adjustments. People often call these above-the-line deductions.
Ah, right, because they come off before you get to that key number.
Precisely. Before you get to adjusted gross income, or AGI. And AGI, well, it's more than just a subtotal. It's like a gatekeeper. Super important because lots of other deductions, credits too, they get limited or even phased out based on your AGI. So yeah, a lower AGI, that can literally unlock more tax savings for you. Okay, so from AGI, you subtract either the standard deduction or itemized deductions, whichever works out better for you, naturally. That gets you to taxable income before the QBI deduction. Then maybe you might get to take the qualified business income deduction, the QBI.
QBI, that's more for self-employed folks, right?
Yeah.
Or small business owners.
Generally, yes. It's mainly for self-employed individuals. Owners of pass-through businesses think S-Corp partnerships. It's designed to give them a bit of a break, reduce their taxable income. After that, you finally land on your actual taxable income. This is the number your federal income tax is calculated on. So we calculate the federal income tax based on that. Then comes the good part, maybe, subtracting tax credits.
Credits, those are the best kind, dollar for dollar reduction.
Exactly. Direct reduction from the tax you owe. Then you add any other taxes that might apply. And finally, subtract payments you've already made, withholding from your paycheck, estimated taxes. And the very last step, that reveals the tax to owe. Or refund, the moment of truth, as you said.
So what does this whole journey mean for you, the listener? It means every single dollar, how it moves through this formula, it hits your wallet directly. And getting a handle on these pieces, it's not just about filing correctly. It's really step one to taking control, maybe finding savings you didn't even realize were there. Okay, so you've got the big map, the formula. Now let's zoom in. Let's look at the actual ingredients, what really counts as income. And what about those deductions, the tools you use to lower that income before you get to the taxable part?
Right. So gross income. Think really broadly here. It's not just your W-2 wages. It's also interest income, maybe from a savings account, dividends from stocks, even state tax refunds can be income, but usually only if you itemize deductions on your federal return the year before. Oh, and alimony received, that counts too, but there's a catch.
Ah, the date thing.
Yeah, only for divorce or separation agreements dated on or before December 31st, 2018. Big change after that. Then you've got business income, if you run your own show. Capital gains or losses from selling assets like stocks. Income from an IRA distribution. Pension and annuity payments. Rental income or loss. Unemployment compensation, definitely income. Even Social Security benefits can be taxable, depending on your other income.
And what about K-1s? You mentioned K-1 flow-through income loss. What's that about?
Good question. That's typically income or loss from a partnership or an S corporation where you're an owner or partner. It sort of flows through the business directly onto your personal return via that Schedule K-1 form. You're taxed on your share.
Got it. Okay, so that's income. Now, before we hit AGI, let's talk adjustments. These are really powerful because they lower that critical AGI number. Things like contributions to a traditional IRA. That's a big one for many people.
Definitely. And paying student loan interest. Putting money into a health savings account, or HSA.
Right.
Well, for teachers, there are educator expenses. For military folks moving under orders, some moving expenses might still apply.
Okay.
And for the self-employed crowd, this is huge, deducting 1/2 of your self-employment taxes. Also, premiums for self-employed health insurance and contributions to self-employed retirement plans, like a SEP IRA or solo 401k.
Those sound really significant.
They absolutely can be. Also maybe a smaller one, but the interest withdrawal penalty if you took money out of a CD early.
Yeah.
And just like alimony received, alimony paid is an adjustment. But again, only for those pre-2019 agreements.
Right, that date keeps popping up. Okay, so we've reduced gross income down to AGI using adjustments. Now what? Standard versus itemized.
Exactly. You calculate your AGI, then you make a choice. Take the standard deduction amount for your filing status, or calculate your itemized deductions. You get the one that's bigger, the one that saves you more tax.
And itemizing.
Yep.
That involves keeping track of specific expenses, right?
It does. The main categories are medical expenses, but there's a hurdle. You can only deduct the amount that's more than 7.5% of your AGI.
Oof. Yeah, that's a high bar for many.
It is. Then you have state and local taxes, or SALT. This includes property taxes plus either your state and local income taxes or your sales taxes. But here's a really key insight, a major change from a few years back. This whole SALT category, it's capped, limited to $10,000 per household per year.
Right, the SALT cap. That really changed the game for people in high-tax states, didn't it? Made the standard deduction way more attractive for a lot of folks who used to itemize.
Absolutely. It forced a whole different kind of tax planning. After SALT, you've got interest expense you paid. Usually this means home mortgage interest and maybe investment interest expense, though that has its own rules. Then, charitable contributions. You can deduct what you give to qualified charities, but there are limits, usually based on a percentage of your AGI, and they vary depending on what you donate and who you donate to. And finally, a less common one, casualty or theft losses. But now, these are generally only deductible if they happen in a federally declared disaster area. And even then, you have to subtract a $100 floor per event and 10% of your AGI from the loss amount.
Okay, whew. That's a lot of detail on income and deductions. So let's shift gears slightly. Once you kind of have a grip on all that, the most basic question comes up. Wait, do I even have to file a tax return? It seems simple, but...
It's not always obvious. Yeah, that's a fundamental first step. The general rule is you have to file if your gross income hits a certain threshold. That threshold is usually your regular standard deduction amount, plus any extra standard deduction you get for being 65 or older or blind.
Okay, but there are exceptions.
Right. The main exception to that calculation method is if your filing status is married filing separately. The rules are a bit different there. And even if your income is below that main threshold, you might still have to file. For example, if you owe special taxes, like self-employment tax, or if you receive distributions from a health savings account. Or importantly, you might want to file even if you don't have to.
Why would you want to file if you don't have to?
To get money back.
Yeah.
If you had federal income tax withheld from your pay, or if you qualify for refundable tax credits like the Earned Income Tax Credit or parts of the Child Tax Credit, the only way to get that refund is to file a return.
Ah, good point. Okay, so you figure out if you need to file, then the big question, when? We all know April 15th looms large.
It does. April 15th is the standard deadline for most individual taxpayers. Feels pretty solid.
But life happens, right? What if you just aren't ready? Is there any wiggle room?
Thankfully, yes. There's an automatic 6-month extension. It pushes the filing deadline to October 15th.
Automatic, so you just don't file by April.
Well, not quite. You have to request it. You file Form 4868, Application for Automatic Extension of Time to File, by the original April 15th deadline. It's usually pretty straightforward to do electronically.
Okay, so you get more time to file the paperwork.
But and this is the crucial point people miss, it is not an extension of time to pay any taxes you owe.
Ah, big difference.
Huge. If you expect to owe money, you still need to estimate that amount and pay it by April 15th, even if you're filing for the extension. If you don't, you could face penalties and interest charges on the unpaid amount. So extension to file, yes. Extension to pay, generally no.
Got it. File Form 4868 for more time to prepare, but pay by April 15th if you owe.
Okay. Moving on. Filing status. This feels like one of the biggest decisions you make right at the start of your return.
It absolutely is. It has a massive impact. It determines your standard deduction amount, and it dictates which tax brackets apply to your income. Getting it right is fundamental.
And it's based on your situation at the end of the year, the end-of-year test. That's the general rule, yes. Your marital status on December 31st determines your filing status for that entire year. Sounds simple, but...
Where do people get tripped up? What are the common pitfalls, and what's the real financial impact of getting it wrong?
Well, let's break them down. First, single. Pretty straightforward. You're considered unmarried for the whole year if, on December 31st, you are unmarried or legally separated according to state law. Then, married filing jointly. This is usually the most beneficial for married couples. You qualify if you're married and living together, or even living apart but not legally separated or divorced. If you get married during the year, say on December 30th, you can file jointly for the whole year.
What about if things change mid-year? Divorce? Or, sadly, if a spouse passes away?
Right. If you get divorced during the year, you cannot file jointly for that year. You'd likely file as single or maybe head of household if you qualify. But if one spouse dies during the year, the surviving spouse can usually still file a joint return for the year of death. Next option for married folks, married filing separately. Any married couple can choose this. Sometimes it makes sense, but often it results in a higher total tax than filing jointly.
Why is that?
The tax rates are often less favorable, and you can lose eligibility for certain deductions and credits when you file separately. Also, how you handle income and deductions depends on your state. In a separate property state, you report your own stuff. But in a community property state, think California, Texas, Arizona, places like that, you generally have to split most community income and deductions 50-50, which can get complicated. Okay, then there's a special status, qualifying widow with dependent child.
That sounds specific.
It is. It lets a surviving spouse use the favorable joint return tax rates and standard deduction for 2 years after the year their spouse died. But there are strict conditions.
Like what?
You can't have remarried. You must have a dependent child, stepchild, or adopted child, not a foster child, living with you for the entire year. And you must have paid more than half the cost of keeping up that home for the year.
So it provides a cushion for a couple of years after losing a spouse if you have a child at home?
Exactly. It recognizes that transition period. After those 2 years, you'd likely file as single or head of household if you qualify. And that brings us to head of household. This is often better than single larger standard deduction, wider tax brackets meaning less income taxed at higher rates, but the rules are tougher.
Okay, lay them out for us. What does it take to qualify as head of household?
All right, several key tests here. First, you generally need to be unmarried or considered unmarried on the last day of the year. Considered unmarried can apply if you're married but lived apart from your spouse for the last 6 months of the year, file separately, and pay more than half the cost of keeping up your home, which was also the main home of your dependent child for more than half the year. Second, you can't be a qualifying widow. Third, you can't be a non-resident alien at any time during the year. And fourth, the big one, you must have paid more than half the cost of keeping up a home that was main home for more than half the year for a qualifying person.
Okay, qualifying person. Who counts?
It can be a qualifying child, according to the dependency rules, your child, stepchild, foster child, sibling, step-sibling, or a descendant of any of them who lived with you for more than half the year. Or it could be your father or mother if they qualify as your dependent. Here's a twist. Your dependent parent does not have to live with you.
Really? How does that work?
You just have to pay more than half the cost of keeping up their main home for the entire year. This could be their own home or even a nursing home. Keeping up the home includes rent, mortgage interest, property taxes, utilities, repairs, food eaten in the home, that kind of stuff.
Interesting. So you could support your parent living elsewhere and still get head of household status? Anyone else qualify?
Yes, other dependent relatives can count, but they must live with you for more than half the year. This includes grandparents, siblings, aunts, uncles, nieces, nephews, and various in-laws and step-relatives.
Who doesn't count?
Cousins don't count as relatives for this purpose. Neither do foster parents. And unrelated dependents living with you don't qualify you for head of household status, even if they meet the qualifying relative dependency tests. They have to be on that specific list of relatives or be a qualifying child. And here's a key pass key or tip to remember the time frames, because they trip people up. Qualifying widow requires the dependent child live with you the whole year. Head of household requires the qualifying person live with you more than half the year. Small difference, big impact.
Wow. It really highlights how choosing the right filing status based on these very precise rules can seriously change your tax bill and what benefits you can get. You could easily leave money on the table just by picking the wrong box. Which leads us right into the next critical piece, actually defining who counts as a dependent. Because as you said, getting those advantageous filing statuses or claiming certain credits like the child tax credit, it all hinges on having either a qualifying child or a qualifying relative. And a quick but vital admin note, you need a social security number for any dependent who is 1 year old or older by the end of the tax year. Also, another little passkey tip. You still get the dependency benefits for a child even if they were born or, sadly, died during the year. They don't have to be around for the full 12 months.
Exactly. So let's break down the 2 types of dependents, starting with qualifying child. There are 5 main tests here. First, the relationship test. Must be your son, daughter, stepchild, foster child, placed by an agency, brother, sister, half-sibling, step-sibling, or a descendant of any of these, like a grandchild, niece, or nephew. Includes adopted children, too. Second, the age test. The child must be younger than you, unless totally and permanently disabled, and either under age 19 at the end of the year or under age 24 if they were a full-time student for at least 5 months of the year.
What counts as a full-time student?
Good question. It means they attended an educational institution, school, college, university that has a regular faculty and curriculum, and they were enrolled for the number of hours or courses the school considers full-time. That 5-month rule is key. It doesn't have to be consecutive months. Third, the residency test. The child must have lived with you for more than half of the tax year. Temporary absences like for school, vacation, or medical care usually count as time lived with you. Fourth, the support test for a qualifying child is a bit different than you might expect. The child cannot have provided more than half of their own support during the year. It's not about how much you provided, but how much the child provided for themselves.
Interesting distinction. What counts as support?
Basically, the cost of necessities. Food, lodging, clothing, education, medical care, recreation, transportation, actual expenses paid. Things like Social Security or welfare benefits used for support do count towards the total support amount. But here's a crucial point about support for students. Scholarships received by your child who is a full-time student are generally not counted in the total support calculation when figuring out if they provided more than half their own support. This helps parents continue claiming their college-age kids.
That's a really important detail for parents with kids in college. So scholarships don't count against them in the support test.
Right, for your child, stepchild, or adopted child who's a student, it doesn't apply quite the same way to, say, a younger sibling you're supporting. And the fifth test for a qualifying child, joint return test. The child cannot have filed a joint return with their spouse for the year unless they filed it only to claim a refund of withheld taxes, and neither would have owed tax if they filed separately. Also, the child must be a U.S. citizen, U.S. resident alien, U.S. national, or resident of Canada or Mexico. And critically, there's no gross income test for a qualifying child. They could have earned quite a bit, and you might still claim them if they meet the other tests.
No gross income test. That seems like a big difference from the other type of dependent.
It is. And one more special rule here. If a child meets the rules to be a qualifying child from more than one person, like divorced parents or a child living with a parent and grandparent, there are tiebreaker rules. Usually, the parent gets priority. If it's two parents not filing jointly, the parent the child lived with longer gets to claim them. If equal time, the parent with the higher AGI claims the child. If no parent can claim the child, the person with the highest AGI among the eligible claimants can claim them, but only if their AGI is higher than the parent's AGI. It gets complicated.
Wow, okay, so that covers qualifying child. Now let's switch to the other category, qualifying relative. How does this differ?
Okay, qualifying relative. 4 main tests here, and they are different. First, this one does have a gross income test. The person's gross income for the year must be less than a specific amount, which is indexed for inflation. For 2023, it was $4,700.
Less than $4,700 in gross income. That seems pretty low. What counts towards that limit?
It's their taxable gross income. So things like wages, self-employment income, taxable interest, dividends, rental income, that all counts. But non-taxable income like tax-exempt interest, tax-exempt scholarships, or most Social Security benefits if their income is low, does not count towards this limit.
Okay, that distinction between taxable and non-taxable income is key for the gross income test. What's next?
Second, the support test for a qualifying relative is about you. You must have provided more than half, over 50%, of the person's total support for the year. Here, it is about how much you paid versus the total cost of their support from all sources.
So for a qualifying child, they can't provide more than half their own support. For a qualifying relative, you must provide more than half their total support. Got it.
Exactly. Third, the joint return test is similar. The person usually can't file a joint return unless it's just for a refund. Fourth, the citizenship or residency test is also the same. U.S. citizen, resident alien, national, or resident of Canada or Mexico. And finally, the relationship or member of household test. They either have to be related to you in one of the ways specified.
Which includes?
Children, grandchildren, parents, grandparents, siblings, aunts, uncles, nieces, nephews, and various step and in-law relationships. Importantly, cousins and foster parents are not considered relatives under this test.
Okay, so they have to be on that relative list.
Or, if they aren't on that list, they must have lived with you as a member of your household for the entire year. So, a non-relative, like a friend or partner, could potentially be your qualifying relative, but only if they lived with you all year, met the gross income and support tests, and your relationship doesn't violate local law. This is also how foster parents or cousins could qualify by living with you all year.
It's incredible how detailed these rules are. One factor like residency or income or relationship can completely change whether you can claim someone. You really need to check all the boxes. It's definitely not just about helping someone out financially. Now, you mentioned situations where things get tricky, like when multiple people support someone. Let's dive into those specific scenarios.
Right. Two common ones create confusion: multiple support agreements and children of divorced parents. Let's start with multiple support agreements. This applies when two or more people together provide more than 50% of someone's support, but no single person provides more than 50%.
Okay, so like siblings supporting an elderly parent together.
Exactly like that. If that's the situation, one of the supporters can still claim the person as a dependent if certain conditions are met. First, the person being supported must meet all the other tests to be a qualifying relative: gross income, joint return, citizenship, except for this standard 50% support test. Second, the person claiming the dependent must have provided more than 10% of the total support.
So you need a group effort covering over half, and the claimant needs to chip in at least 10%.
Correct. And third, all the other individuals who provided more than 10% of the support and who could otherwise claim the person if not for the support test must sign a written declaration, Form 2120, stating they will not claim that person as a dependent for the year. The person claiming the dependent attaches this form to their return. Let's use that example you mentioned earlier to make it concrete. Peter, single, no income, total support is $5,000. Tim, an unrelated friend, gives $2,448%. Angie, Peter's sister, gives $2,150, 43%. Mike, Peter's son, gives $450, 9%. Together, they provide 100%. No one provided more than 50%.
Okay, so who can claim Peter, assuming he meets the other qualifying relative tests, like gross income?
Well, let's see. Tim provided 10%, but he's not a relative and didn't live with Peter all year, so he's out. Mike is Peter's son, a relative, but he only provided 9%, which is less than the required 10% threshold for a multiple support agreement. That leaves Angie. She's Peter's sister, a qualifying relative. She provided 43%, which is well over the 10% requirement, and together, Angie, Tim, and Mike provided 50% support. So if Tim and Mike agree not to claim Peter and sign Form 2120, Angie can claim Peter as her dependent qualifying relative.
That makes perfect sense. It really shows how you have to apply all the rules, including that 10% minimum contribution for the claimant. Okay, what about the other tricky one? Children of divorced parents.
Yes, this causes a lot of headaches. The general rule focuses on custody. The parent who has custody of the child for the greater part of the year is generally the one entitled to claim the child as a dependent for tax purposes, including things like the child tax credit and head of household status.
Custody, defined by time spent with the child, not necessarily what the divorce decree says about who can claim them.
Exactly. That's a huge point of confusion. Tax law prioritizes physical custody, where the child lived for more nights. It often overrides whatever the divorce decree might state about claiming dependents, unless the custodial parent explicitly releases the claim. And it doesn't matter which parent provided more financial support under this general rule.
What if custody is split exactly 50-50?
If the child lived with each parent for the exact same amount of time, then the parent with the higher adjusted gross income, AGI, for the year gets to claim the child.
Okay. But can the non-custodial parent ever claim the child?
Yes, they can, but only if the custodial parent signs a specific form, Form 833D2, release revocation of release of claim to exemption for child by custodial parent, or includes similar language in the divorce decree itself, effectively giving the dependency exemption and potentially the child tax credit to the non-custodial parent. The non-custodial parent then attaches this form or decree pages to their return.
So communication and formal agreement between the divorced parents is really key if they want something different from the general custodial parent claims rule.
Absolutely essential to avoid problems with the IRS.
Man, we have really covered a ton of ground today. We started with that big picture tax formula, your financial roadmap. Then we figured out who actually needs to file and when. We tackled the super important decision of filing status, and then dug incredibly deep into who you can claim as a qualifying child or qualifying relative, even hitting those tricky multiple support and divorced parent situations. Hopefully, for you listening, this deep dive has demystified some of this and given you a much clearer picture, armed you with some solid insights.
Yeah, I think a huge takeaway here is realizing how these fundamental rules really empower you. Knowing this stuff helps you make informed choices, potentially save real money, avoid penalties, or at the very least, just feel less stressed and more confident when tax time rolls around. It puts you more in control.
Definitely. So, as you think about your own tax situation, maybe reflect on which filing status truly fits, or double check those dependency rules for your kids or relatives. Perhaps just understanding one of these pieces better leads to that aha moment. And maybe a final thought to chew on. Beyond just filling out Form 1040 correctly, how might a better grasp of these foundational tax concepts like AGI, deductions, credits, dependency influence other parts of your financial planning or decision making throughout the year? Where else might this knowledge pay off?